Hello, everybody, and welcome to a special edition of our Smart Tax School webinar series. My name is Amar Medic, and I'm the Product Marketing Manager for TaxWise. In today's webinar, we'll be covering business-related changes from the One Big Beautiful Bill Act. Topics covered include depreciation and expensing changes, compensation, and employer-related changes. Keep in mind that we do try to host at least one webinar per month, so if you find today's session to be informative, please be sure to join us in the future. During the webinar, you'll be able to submit questions to the team and get those answered live at the end. And with that said, I'm very pleased to introduce our special speaker for today, Michael Hannigan. He's a federal tax editorial manager here at Wolters Kluwer with years of experience working in the tax industry. He's the managing editor for all of the federal tax content in CCH AnswerConnect and has been the managing editor of the U.S. Master Tax Guide since 2013. So with that, let's get started. Michael, please take it away.
All right, thank you, Omar. Hi, everyone. I'm happy to be here with you today. I am going to be talking about the business-related provisions of the One Big Beautiful Bill Act, like Amar said. Business-related is going to be very, very stretched in its definition during this talk today, right? So, and we'll kind of get into that a little bit more as we go along and what I mean by that. But so I guess we'll kind of just get into it a little bit here. Like Amar said, today's objective is to review those business-related changes. That's going to include some changes to depreciation and expensing, some stuff related to compensation, and then more stuff that has to do with a business owner as an employer rather than as in the true business parts of running a business. So kind of a lot to get through. We're going to get going. We'll get started. And here we go. We're going to start out with depreciation and expensing. The big change for depreciation from the One Big Beautiful Bill Act has to do with bonus depreciation. Bonus depreciation has been kind of coming and going over the last 20 years or so. I think, and don't quote me on this, I think they first kind of introduced it back in the early 2000s. It tends to come in a lot when, Congress maybe wants to spur some growth or spur industry growth. It's very pro-business provision. It does tend to trend more towards, the higher end of incomes for business, but, it's available to everyone, right? So basically, it's for, depreciable 20-year property. It's been coming and going, like I said. So like during the Tax Cuts and Jobs Act, or in the Tax Cuts and Jobs Act, was the most recent passage of a 100% bonus depreciation provision. And that was 100% through, I want to say, I think 2021 or 2022. And then it would step down so that it was 80% for the year and then 60%. And for 2025, it was supposed to be 40% first year bonus depreciation. The One Big Beautiful Bill Act brought it back and gave it there's no expiration to it, right? So there's no step down. It's, currently 100% forever, notably for property acquired after January 19th, 2025. If it was before January 20th, 2025, it's still subject to that 40% limitation on the bonus amount. It is reported on Form 4562. It is automatically applied. You don't have to elect to claim it. In fact, you have to elect not to claim it, right? So, if you do elect not to claim it, or you previously elected not to claim it and want to, get rid of that election, there's generally an accounting method change that you have to report on Form 3115. But yeah, so we'll kind of keep going on that a little bit. Bonus depreciation is generally for section or for 20-year property under makers, right? So that's factory equipment, right? That's a big machine, that's that kind of thing, right? That's the kind of 20-year property that it applies to. It also applies to some additional things as Congress has, so chosen. Notably, film and television recordings are eligible for bonus depreciation, things like that. The One Big Beautiful Bill Act expands that even more, right? So the first way it expands it is to qualified production property. What is qualified production property? It is property engaged in qualified production assets. Activity, that's a qualified production activity. It is basically for manufacturing, but in this case, it's for real property, right? So it's for Section 1250 property. It's anything with the 27.5-year recovery period. It's for, land and physical buildings are now eligible for bonus depreciation. And it qualifies if you build the building or if you acquire a used building. But again, it has to be engaged in qualified production activity. What Congress has spelled out as what qualified production activity is generally in the agricultural industry or in the chemical production activity industry. So, so it's, factories and, I assume some sort of agricultural processing facilities, things like that. So it also expanded bonus depreciation, sorry to go back, the qualified production property expansion is only for property constructed or acquired after January 19th, 2025, and it has to be placed in service before January 1st, 2029. Generally, there are some exceptions to that. It also expanded bonus depreciation out to sound recordings. So like I had said earlier, it's available for film and television, and I think like stage productions, like Broadway productions, that kind of thing. It expands that out more to sound recording property and facilities. So that's, kind of treating the music industry basically like it already does the film and television and theater industry. So moving along is the Code Section 179 deduction. There weren't any huge changes to this. Basically, what we saw is an increase in the dollar amount. So, this is for immediate expensing of 179 property. Before the One Big Beautiful Bill Act for 2025, the limits were 1.25 million, the dollar limitation, and the overall investment limitation was 3.13 million. Those were adjusted for inflation. Obviously, that's why you end up with weird numbers. But for 2025, OBBBA increased those to 2.5 million and 4 million, respectively. Again, 179 property is Section 1245 property. So basically, again, like, equipment and machines and things like that, but not something that is eligible for bonus depreciation. The other change for expensing that we saw was for research and experimental expenditures. Again, like bonus depreciation, the immediate deduction for research and expensing, or research and experimental expenditures, is been made immediately deductible in some previous years. Again, that's for a period of time that usually sunsets and expires. Otherwise it has to be capitalized over the over 10 years, I think, or 10 years or 60 months. No, it's 10 years. So again, different exceptions apply and things like that. What the One Big Beautiful Bill Act did was make it immediately expensable, again, permanently, but only for domestic expenditures. Foreign expenditures still have to be capitalized over that 10-year period. Again, and there's still a credit for research and experimental expenditures, right? But you can't take both. You can't immediately expense it and take the and claim the credit for it. So let's keep going. I think now we have our first polling question. Yes. So true or false? Foreign research expenditures can be immediately expensed under the One Big Beautiful Bill Act. A is true, B is false. Take a minute, please, and go ahead and answer. I'll give you a minute. Give it 30 more seconds. A few more seconds to go. 5 more seconds. Okay, so the answer to that question is false. The One Big Beautiful Bill Act only extended immediate expensing and immediate deduction for research and development research and experimental expenditures to domestic expenditures, not foreign expenditures. All right. So we'll keep on going. And we're going to move on to other business deductions and credits beyond what we already talked about. First one we'll talk about is the qualified business income deduction. This is sometimes referred to as the pass-through deduction. It is basically a 20% deduction for qualified business income. This first came into effect as part of the Tax Cuts and Jobs Act. It kind of sort of replaced the old 199 deduction. This is, it came in under the Tax Cuts and Jobs Act. Like a lot of the things in the Tax Cuts and Jobs Act, it was set to expire at the end of 2025. What the One Big Beautiful Bill Act did was make it permanent. So it's not going away now. There was some back and forth during the run-up to the passage of the bill of increasing the amount of the deduction. I think it was 25% or 22%, but ultimately in the bill it stayed at 20%. There are phase-in limitations that come in depending on the amount of income that you have. What the One Big Beautiful Bill Act is change those. It changed the phase-in range, so the phase-in range starts at the same place, and the limitations on the deduction kick in the higher the income gets. That's it's a phase-in, but it basically extended out the phase-in range. It used to be a $50,000 phase-in range, and now it's $75,000 for individuals. Single, and for joint filers it's $150,000 instead of $100,000. That's really the big change from the qualified business income deduction. Another thing that they put in there though was for a minimum deduction. So taxpayers that had relatively low amounts of qualified business income, that 20% didn't necessarily give you a lot, right? So for taxpayers with at least $1,000 of qualified business income, there is a $400 minimum deduction, a minimum qualified business income deduction, beginning after 2025. I'm sorry, and obviously, when you get to $2,000 of qualified business income deduction, that is, where the minimum no longer applies, and you're just at the 20%. So anything between $1,000 and $2,000 of qualified business income deduction would be able to take advantage of that $400 minimum deduction. The $400 minimum deduction is adjusted for inflation after 2025. So I think I might have a mistake here. I think the minimum deduction kicks in 2025, and it's adjusted for inflation beginning next year. So sorry about that. I have a mistake on the slide. But yeah, but that's the big change for the 199A deduction. Keep going. Some additional changes that apply to businesses. If you've been watching TV in the last 3 months and have seen a car commercial, you would have seen that the commercial clean vehicle credit, or the clean vehicle credit, in general, is expiring on October 1st. I feel like all through the summer after the bill passed, like every commercial you saw say, "Oh, get your electric vehicle credit by September 30th." That is not just for individual and people buying their personal cars. That applies to the commercial clean vehicle credit as well. This was the $7,500 credit. So there's still 5 days to go out and buy that. Tesla for your business if you want to. The other big change, another change that applies to businesses, is the limitation on excess business losses. This was another thing that was part of the Tax Cuts and Jobs Act, but the effective date kept getting delayed, and especially kept getting delayed during the pandemic. It was supposed to kick in, I think, in 2020, and then they kicked it out to 2022. It does now apply, and it's being made permanent. It was subject to the same sunset as many of the Tax Cuts and Jobs Act provisions. No change to that other than a slight change in how the inflation-adjusted amount is calculated. And I noticed I intended to put the projection in there, but I didn't. But I think it's somewhere, I think it's around $300,000 for a single, and $600,000. It's somewhere in that ballpark for married filing jointly. So sorry I missed that. Obviously, it's for non-corporate taxpayers only, but it's just a limitation on excess business losses. The other change to some business costs is the business interest deduction limitation. Again, this is something that came in under the Tax Cuts and Jobs Act. The limitation itself isn't any different. It's just kind of how the limitation is calculated. So, the deduction is, it's a limit on the deduction of business interest to 30% of the taxpayer's adjusted taxable income. Previously, you could not exclude amortization from that calculation of adjusted taxable income, but now you can. So basically, it aligns ATI for purposes of the limitation on the interest deduction, along with true business earnings, which is EBITDA. So it used to just be EBIT, but now it includes the A. So that is that. A couple other changes that apply to businesses. I believe it was under the Inflation Reduction Act that was passed, the energy efficient commercial building deduction. It was an amount based on, I think, the square footage of the business of the building being built. That is one of the provisions that was eliminated, along with many of the green energy provisions from the Inflation Reduction Act. So that was eliminated by the One Big Beautiful Bill Act. It has a delayed effective date, so it is still available now, and it will be available for property beginning construction before the middle of next year. So if a business is mid-flight on doing that, or can get something together quickly, that deduction would still be available. But after June 30th. The deduction is no longer available. You can still claim the deduction, obviously, for something that was built in the first part of the year, but after that, it's not going to be available. One Big Beautiful Bill Act made a lot of changes to charitable contributions kind of across the board. But for businesses, the big one is there is a 1% floor on corporate charitable contributions, and deductions are limited to 10% of taxable income, but you can carry that forward year after year. So that is new as well. And I think, do we have, oh yes. So we're going to move on to our next polling question. Can a business claim a clean vehicle credit for an electric vehicle purchased after September 25? Or is the credit only eliminated with regard to individuals? So go ahead and answer that. Give you a minute. Any seconds? A few more seconds. We'll head on over to the next slide. Okay, get your questions in, get your answers in, and we're gonna move on. The credit has been eliminated for all taxpayers, not just for individuals, not just for businesses, but for everyone. So, so kind of like I said at the beginning, you know, just kind of going back over what we've talked about a little bit. A lot of the, you know, true business changes from the One Big Beautiful Bill Act were really more, you know, obviously some extensions, right? Making some provisions permanent that were subject to sunset under the Tax Cuts and Jobs Act. But then also just kind of little tweaks, right? Like, you know, you can apply bonus depreciation to this, you know, additional category of property, or, you know, like that change to include amortization in the calculation of adjusted taxable income for the business interest limitation. You know, a lot of things like that. So where we saw a lot more of the changes that applied, that businesses might have to be aware of, are really more in the business's role as an employer. So, you know, first we're going to kind of get into these compensation changes, and then the bulk of this presentation is going to be more on the, you know, employee relations side of things. So starting with compensation, we're going to talk about tips more in a little bit. So, you know, don't think this is it on tips, believe me. But there is a tip credit for the FICA tip credit, which is a credit against an employer's employment taxes for amounts received by employees as tip income. Historically, that credit was only available to you know, restaurants and bars, so it was only for, you know, food and drink employees. The credit is now expanded to also apply to people in the beauty service industry. So, and that applies after 2024, so that applies this year. So that's something to be aware of. There has been for a long time a deduction limit for compensation for businesses, a $1 million limit on that deduction. What the One Big Beautiful Bill Act did was apply that limit to aggregated businesses. So if you have, you know, a larger business that has like a consolidated operation or a controlled group, and you had an employee who was a member of two different parts of the same controlled group, a corporation has to aggregate both roles in making that calculation of when the $1 million compensation limit applies. So that's something to be aware of. That's really it on compensation. Now we're going to get into the bulk of these these changes related to a business's role as an employer. So the two big ones that came out of this, right, is what is referred to as no tax on tips and no tax on overtime. That's not technically what they are. That's a deduction, right? It's the qualified tips deduction and the qualified overtime deduction, but they are still referred to colloquially as the no tax on tips and no tax on overtime. So let's talk about no tax on tips a little bit. That applies to 2025. That is this year, and it goes through 2028. Individuals are able to claim up to a $25,000 deduction for qualified tip income. Obviously, employers are currently supposed to be tracking tip income, right? They have to report that on a W-2, but it has to be there's a little bit more reporting that is going to come into it going forward. It still has to be reported on a W-2. For a non-employee that receives tips, they can claim the deduction as well, but they must be reported to them on a 1099 NEC or 1099-K. This is pretty recent. We just got guidance from the IRS on the qualified tips deduction just this week. It was released at the end of last week, but it's dated September 22nd, so that's Monday. They are proposed regulations, but they are reliance regulations. We don't know if there's requests for comments and things like that. So we think there might be some changes to this, but it gives a lot of guidance on what a tip is beyond what is in the letter of the law of the code section. So qualified tips are voluntary payments paid in cash or cash equivalents. So that is paid by cash, check, credit card. It includes virtual currency in there. It doesn't include non-cash items. So like if you tip somebody a ticket to a sporting event or something like that, that does not qualify as a tip for this. It has to be cash or cash equivalent. For an employee, it has to be received from a customer. So it can't be, it's basically saying that you can't treat a bonus from your employer as a tip. It has to be something that is directly received from a customer. It's not qualified if it's for an illegal activity. The regulation also specifically eliminates pornography and prostitution. So, but those aren't necessarily illegal in certain parts of the country, but it's not for any kind of illegal activity. And it does not qualify for any business owner, right? So if you are going to a bar and the owner of the bar is also the bartender, you tip the bar owner, that does not qualify as a qualified tip. The guidance that was released has an extensive list of categories of what these job categories are. I believe the legislation and definitely the regulations specifically says that it is for industries that are generally considered as being industries where there's tipping as of the end of last year. So the guidance has, I think, 8 major categories of industries, and then there's subcategories within there. Why is that important? Each of those subcategories is provided with a Treasury tipped occupation code. It is, I believe, a 3-digit number, and we think that that's going to have to be included on the W-2 from the employer that provides the amount of tip income that is received by the employee. That is our understanding. There hasn't been a draft of a W-2 released yet. There has been a draft version of the form that employees are required to report on for their 1040. And that does not include the TTOC, but we don't know if that draft version of that schedule is final yet, right? So might be a little bit of time before we have an answer on that, but it seems, and the regulations seem to imply that that Treasury tipped occupation code is going to be important. So we are actually working on a way of making that a little bit more user-friendly and a little bit more available to our customers. We are putting together a chart on those TTOCs where you'll be able to search by industry and by job. And hopefully that'll be make it a little bit easier, because it's a pretty big list. It's big. So we're going to keep on moving. Like I said, the other big one out of OBBBA is the qualified overtime pay deduction. That's the no tax on overtime. Again, beginning this year, individuals can claim up to a $12,500 deduction for qualified overtime income, $25,000 for joint filers. It is limited to overtime pay as defined by the Fair Labor Standards Act of 1938. So what does that mean? So if you are a wage-earning employee, if you're on hourly wages, and you work 45 hours in a week, that 5 hours typically entitles you to time and a half pay. It is the half that is deductible, not the time and a half. So just working over 40 hours, if the hourly wage you get for that is not eligible for the deduction. It's only the half time extra that you get, right? So again, employers are going to have some reporting responsibilities on this. We think it's going to be yet another box on the W-2. Unlike the no tax on tips, there hasn't been any real guidance yet from the IRS on that. We're expecting that to come soon, hopefully, but we're going to see how that goes. There are a lot of restrictions in the code about like what is qualified, right? Like, it's not it's got to be from a single employer, obviously. If you work 30 hours for one employer and 20 hours for the other, neither one is, obligated to pay you overtime for the aggregated amount, right? So, so it is going to be, we assume, employer specific. But yeah, so that's that. Again, something you're gonna have to pay attention to as an employer just for reporting responsibilities, right? It's a little bit more, obviously for tips, employers should already be tracking that, reporting that, but overtime is going to be a different story. So again, like as an employer, this isn't really relevant, but employees, you don't have to itemize deductions to claim either of these things either. Not that that would, negate the reporting obligation from the employer anyway, but just so a lot of this is stuff that might come up in conversations with employees, and that's certainly what's going to be the rest of the conversation. So some changes to employee benefits. So like I just said, a lot of the rest of this is really more interactions with employees. We'll get into some kind of individual credits and benefits that are available and exclusions that might come up as well, just in conversations, or something that HR departments might have to communicate to employees. Employer-provided meals has been pretty squishy the last couple of years, right? So the Tax Cuts and Jobs Act made some changes, limited it to 50% in some cases, a 50% deduction, or outright eliminated it where the employee is allowed to exclude it from their income. That is no longer allowed except in very, very limited circumstances. Employer-provided meals are generally not allowed to be deducted anymore. The exception applies to meals provided to people working on like fishing and shipping vessels or on oil rigs, that kind of thing, right? So it's a very, very limited exception. Another change for employee benefits is the education assistance exclusion. That's been a $5,250 exclusion as far back as I can remember, right? So This is if an employer pays for, education, like, if you are an accountant and you're going to get a master's in accountancy, like, your employer may pay for some of those classes. That's been stuck at 5250 forever. Beginning after 2026, that's going to be adjusted for inflation. So finally some changes there, some increases there since school hasn't gotten cheaper. Also in the Tax Cuts and Jobs Act, I believe, employer payments of student loans was also eligible for exclusion, again, subject to that same 5250. That is being made permanent. So I think that was set to expire at the end of this year, but that is permanent going forward. Dependent care assistance programs. So that is if an employer pays for daycare, either through like a FSA or some other means. That has been locked in at $5,000 for quite a few years. The limit on that is increasing to $7,500. So moving along, again, stuff that might come up as far as conversations between employers and employees. The health insurance premium tax credit saw some changes, largely related to who is eligible to claim the credit. If you came in due to a special enrollment program, which I think involved people on Medicaid, that is not available after 2025. After 2026, the credit is limited to only lawfully present aliens, and it's not available for anyone that is ineligible for Medicaid. One thing to keep note of for this is the premium tax credit was increased temporarily under the American Rescue Plan Act, I believe, in 2021. Those increased credit amounts are set to expire at the end of this year. There's been a lot of talk in Congress about extending those. Obviously, I think nobody wants their constituents to have sticker shock from their health insurance. It's one of the things that is being talked about as possibly being included on a bill in the next few days to fund the government to avoid a shutdown. Democrats are pushing really hard for that, and I know some Republicans are too. But it's not clear whether that's going to be included now or if they're going to touch it later. But we do expect there might be some patch for that before the end of the year. But regardless, these changes under OBBBA are going to be locked in, we think. So like this elimination of the credit in 2026 and 2027 for specified taxpayers is going to probably not be changed by anything that happens at the end of this year. There's also the employer credit for paid and family medical leave. That is a 25% credit for wages paid for FMLA. That was set to expire at the end of the year. That was made permanent by OBBBA. And after this year, there's also a credit available for premiums paid for employer-owned FMLA insurance policies. So if it's like an AFLAC situation, and the employer pays for those premiums, it's not just for the wages anymore, it's also for the premiums on the insurance plan. So that's something to be aware of. Oh, look at that, FMLA credit again. Ignore that second section of bullets, sorry about that. The employer-provided childcare credit, so that is maybe a situation where an employer has an on-site daycare facility. That has been 25% for a long, long time, up to a maximum credit amount, I think, of $500,000. The credit amount is increased to 40%. And I think I might have that wrong, that old credit was up to a maximum, something less than $500,000. I think it was $200,000. But now after 2025, that credit amount is increased to 40%. Up to a maximum of $500,000. Small businesses can claim that credit up to 50%. I'm sorry, I forgot to write down what a small business is. I think it is a business that can use the cash method of accounting. So that's an inflation-adjusted amount. I think this year it's $31 million. So that's what qualifies as a small business. So it's up to 50% credit, up to $600,000. Multiple small businesses can claim a credit on pooled resources. So maybe if you're sharing a building with another small business and you get together and build a jointly run or provided daycare facility on site, small businesses can pool those resources together and also claim a credit up to $50,000, up to 50%, up to $600,000. Let's see, some other credits just to be aware of that they're out there that you might have employees ask questions about, not necessarily that you have any involvement in as an employer, but sometimes these things do come up. The adoption credit, which is, I think it's $13,000 is the maximum credit for 2025. Up to $5,000 of that credit after 2025 may be refundable. So, a refundable credit is where if you don't have enough taxable income enough tax on your taxable income to claim a credit, you can go over and above the tax amount to claim a credit. That's what a refundable credit is. Child independent care credit. Again, this is not for on-site daycare facilities. This is for off-site daycare facilities. Parents could get a credit of, I think it was 35% was the maximum. The maximum credit increases up to 50% now, up to $75,000 of taxable income. It phases down, and AGIs over $75,000, the credit phases down to 20%, but no lower than 20%. So there's always some credit to be able to be claimed for child independent care expenses. And yeah, so that's it. So just some kind of key takeaways for this. Effective dates are all over the place on this bill, right? So like there were some things that take effect in 2025, some things in 2026, some things after 2026. So kind of just be aware of what you have to do and when, right? A lot of the big stuff does take effect in 2025. So that's the no tax on tips, no tax on overtime, bonus depreciation, the 179 deduction. A lot of those big changes from OBBBA do take effect this year. So you might need to start implementing some reporting or tracking or something on your overtime income or tip income before the end of this year, just to be aware of what that is. Like I said, prepare for those reporting changes. Unfortunately, the IRS hasn't provided a lot of guidance on the overtime one, but the tip income is a big one, and we do have reliance guidance now that you can take a look at, and your payroll administrators can start, being aware of and taking action on what they might have to report on their W-2. And the other big one is, prepare for those interactions with employees. A lot of the changes from the One Big Beautiful Bill Act were individual focused, but they're benefits focused, and they are, things that that revolve around their role as an employee. And they might be talking to your HR or asking questions, and might need some additional guidance around that. So just be prepared for those kind of conversations, right? So I think with that, we're going to go to our last polling question. And this one's an actual example. So we have Ernie. Ernie earns $10 an hour at his job. He's an hourly worker, but he works 50 hours in a given week. And for 10 of those hours, he is paid $15 per hour. How much of the $15 is eligible for the overtime pay deduction for Ernie? So go ahead and give you a minute to work on that. Gotta love a polling question with where you have to do math. That's always fun. But all right, we're about halfway there. 30 seconds left. down to about 10 seconds. Five, four, three, two. All right. The answer is only $5 is eligible. It's only the overtime portion of pay received for overtime hours. With that, I am going to hand it over to Ryan. I want to thank you all for your time today. We learned a little something, and it was a pleasure talking to you all today. Thank you.
Okay, thanks for the handoff. And my name's Ryan Hubbs, and we're going to spend probably the last 10 or so minutes going over a product called AnswerConnect. Now, AnswerConnect is our in-house tax research. And when you really think about it, Michael, that was an incredible presentation given that OBBBA just got passed a couple months ago, and we haven't been through a busy season. It's a whole wealth of knowledge that we've already gone and proctored through and figured out. But if you're anything like me, you're not going to be able to have all of this memorized, all these different key changes, as it is such a massive overhaul to the tax code. And what I highly recommend, what I will personally use, is our AnswerConnect in-house tax research. And we have a whole team of different CPAs, MBAs, JDs that will update this in a timely manner. And as a result of that, there has already been a lot of updates for OBBBA within AnswerConnect. So really what I'm going to do here with the last 10, maybe 15 minutes so of the time that we have allocated today is I want to go and just give a brief overview of AnswerConnect, how it's going to work, how you can use this with OBBBA, but really any tax law changes. It's not really just for OBBBA, but just since that's part of the tax code, it's going to be included with our AnswerConnect package. So what I'm going to go ahead and do is I'm going to go and share my screen. Bear with me for 1 second here to make sure I'm sharing the correct screen, which I believe I have right here. And when I log into AnswerConnect, this is going to be our central hub to find the information that we need. Now, when we come to the homepage here, there's going to be some kind of big buttons that we could press where we could look for federal specific items. We could look at the U.S. Master Tax Guide. Most likely, you're first going to come up above here and just search for whatever deduction, credit, tax law change it is that you need to see. But what also may be helpful is coming to the federal tax legislation highlights. As the tax law changes, one of the nice things about this is we are going to create and send to you summaries of some of these changes. And if we look at the changes for the one big beautiful bill, well, it looks like we have about a 6-page document, right? And this isn't meant to be all encompassing, but this is meant to be your morning coffee read, right? As we want to slowly start learning about these changes before we dive into really specific articles, this is going to give us some nice summaries of what's going on, what's happening, and one of these things that's good to review as we start to ramp up and gear up for busy season. In addition to this, how you will most likely use AnswerConnect, though, is you will search for the particular item that you're looking for up above here. And if I type in OBBBA, we've already gone ahead and updated numerous articles with OBBBA within it. And just to kind of zoom in, just so everybody can see, I mean, if you go through these different titles, we have meals provided at convenience of employers, something that we kind of talked about already today. Income tax for individuals, we can see, okay, OBBBA is going to be part of this article. And one of the benefits of using this, as opposed to something like ChatGPT or Google, is this is an in-house tax research literature that has been proctored by us, meaning Wolters Kluwer. So everyone that writes these articles is qualified to do so. They've been vetted by us. And then in addition to that, as the tax law changes, we will update these articles in a very timely manner. One of the problems with something like a Google is you're not always quite sure who wrote the article. Are they as vetted as they say that they are? If the article was correct 2 years ago and you can see it was written in 2023, is it still accurate today? Those are some of the places where you can start to run into trouble. And I would say in the past, the main way to really use this is just bring up different articles and kind of click through and find the specific areas that you need. But with AI being the new kind of hot topic for really anything in regards to the internet, we also now have AI assistants built into this. And it's just a little button. Let me go and backtrack here. Just a little button up here that says AI assistant that you can select. And what this is going to do is I just did a very basic search. I just did OBBBA deductions as my search. I typed it in. And it goes through and it does not scan the internet. It scans the articles that are included with AnswerConnect. So this is going to get you a more detailed, vetted answer than using something like a ChatGPT. A ChatGPT is going to basically take a consensus of all the different articles that it can find on the web, right? And for any of us, myself included, who use ChatGPT quite often, it is not uncommon for it to be wrong. It is not uncommon for it to kind of summarize information that is incorrect. So one of the benefits is this is not looking at the entire web, the entire internet, every article that it can find. This is specifically looking at the articles within AnswerConnect. And then additionally, everything's going to be linked back to the source code. So if I look at the qualified tips deduction, for example, and click this 1.1, well, I can see where this is going to link back to. Let's just go ahead and click it. This will bring up the article where the AI pulled the answer out of. So you can always go through and give this a look for yourself and get a very detailed description and really have that data in front of you to go ahead and make your own distinctions. And as a part of this, as we go through like an AnswerConnect article, it'll also link back to the IRS publications. If you ever feel like you just want to see how the IRS has written it, and then based off the codification of that, you want to go and make your own determination as to like how you should elect an deduction or what's tax strategy you're going to take, just click the link back and it will bring up the actual articles and the actual instructions on how to prepare the tax return. This will also lead oftentimes link back to regulations, which I'll go ahead and do right here. And also a lot of times they'll have the IRS like coding itself. So if you ever feel like you want to really dive in as deep as you possibly can, this is a great tool as well to go ahead and make your own distinctions as to what you should do for that particular client. Now, one of the things with AnswerConnect, I'm not going to get into the pricing as I'm not a pricing expert, but there are many different packages that can be sold, that can be purchased. Some of the packages that are more so on the federal level can be, in my opinion, rather inexpensive. And as you get up and start going into international forms, foreign income, the price will increase. But the main point that I'm trying to get across is there's a lot of different packages, and you can really drill down and focus on what is going to be most beneficial to you. I can tell tell everybody in this presentation today, like I'm the kind of person that I'm going to go through and start learning about OBBBA when I really get into the tax returns, and I will go slowly as I start to hit some of these different issues. And if you're like me, this would be a perfect tool in order to learn more as you go. But this is also meant to be authoritative tax research. So, feel free to use this, quote this if you ever do have an audit under the IRS. Now, a couple last quick things to go over is we are going to have one more polling question. Then additionally, I do want to make you all aware of a promo that is going on in case you are looking to get new tax research. So let me go ahead and stop sharing my screen. And let me go ahead and click on the next slide. Now, at Wolters Kluwer, we have essentially 4 different tax softwares that we sell, tax preparation softwares. That being Access Tax, ProSystem FX, which are very similar. We also have ATX, which is a great value software. You get a lot for what you pay for. Then we also have TaxWise Online and TaxWise Desktop. Now, if you are looking for a new tax preparation software, and that's one of the reasons that you came here today, I want to let you all know that we are currently running a promo. This slide says 20% off. This may have been increased to 25%. Don't quote me on it. But you just would use the business code down here, 25N2N, TWWeb. This is if you're doing an online checkout, and it will go and either give you 20 or 25%. I'm not sure if this slide's been updated. I might be 5% off myself, but I believe it's 25%. And, you can get TaxWise with a pretty significant discount, right? As tax software is typically going to cost, 4 digits or more. So pretty good promo code. I will be coming back to this in just a second, this slide, so don't feel like you have to rush to take this down. But before we do that, I do want to go ahead and open this up to our last polling question. And this is one just to kind of track anyone who may be interested in purchasing something like an AnswerConnect, maybe purchasing a different tax software like TaxWise. We always like to open this up to a polling question and see if you would like for us to reach out to you, maybe give you a one-on-one demonstration. If you have some very particular things with AnswerConnect, for example, and you want to see how it would answer those and what those articles look like, we could get a one-on-one demo potentially set up to you, or at a minimum, get you some literature, get you some pre-recorded videos as well that you could view. So we do have a whole host of different guides here. And If you were just here to learn today and you don't feel a need to look at any additional products, feel free to just go ahead and answer no. This is one of the services at Wolters Kluwer that we like to really offer, just to be, industry-wide leaders in tax research, tax preparation. So it's completely fine if you're not worried or looking to get a new product from us. And then lastly, if you're already using TaxWise or CCH AnswerConnect, just go ahead and let us know. We do like to have a good mix of people that are looking for new software, people that are currently using our software, and like to know kind of what that breakdown is. So going to go and leave this slide open for, 30 seconds or so. And then we'll have about 3 minutes left. I know that we're trying to go through and kind of type out some of the Q&A answers. But once we're done with this slide, I will go and bring this back to the promo slide, just in case anybody missed it. And then we'll end this presentation in probably about 2-3 minutes. So with all that being said, I really want to thank everybody for attending today. We had really good attendance for today's presentation, which I always love to see. And we will be hosting more presentations, some on OBBBA, some on working through tax returns, which we will talk about different schedules, different forms, et cetera, that will be affected by OBBBA. So be on the lookout for additional information, additional webinars, dates from us, as we typically try to host at least one of these, if not more, a month. And I think we're pretty good to go until December. We might take a break in January, February, March when everyone's working on tax returns, but we'll go and pick this back up in April. So looks like we got about 70% of the attendees to answer. So, and it's been about a minute or two here. So I'm going to go ahead and jump back to the promo slide. And with all of that being said, I really have nothing else to talk about or nothing else to go over today. So I'm going to go ahead and hop off camera. I'm going to go and leave this presentation running for maybe 30 seconds to a minute, just in case anyone needs this promo code. And I look forward to working with many of you in the future. Thank you so much and enjoy the rest of your day.